Hi everyone, hope you're doing really well. A question we often get asked is, what type of mortgages do you use when you're buying your properties? And rather than sort of doing the pros and cons of capital repayment or interest only, what we're going to do is I'm going to just sort of give you our insight and our reason, and a really powerful insight, if I could be so bold, in why we use interest only. Now, this is dependent upon a whole host of factors, so don't just use this on its own. You need to have a plan and execute on that plan, and depending upon what your plan is and where you are on that plan will depend upon what type of mortgages you may or may not use. So it's always worth sitting down with a qualified mortgage broker and finding out the product that's best for you and your unique circumstances. This is not by any means financial advice. Now, what I'm going to be using to sort of tease this out is the same spreadsheet that I used in a previous video where we calculate the purchase price for an asset. And if you might look down to this tab at the bottom, it's the purchase price tab. And the second tab across is this capital appreciation. And we need to just really address a couple of things to help us make some conclusions. In this first part of the table, we have a £100,000 house, and we are going to then apply to it a 5% growth compounded over a 10-year period. So this £100,000 house added 5% growth every single year after 10 years is going to be worth £162,889, which of course is an increase of £62,889. And we have then graphed that on this space over here. Now, as I said, we do use interest-only mortgages. And we typically go for 75% loan to value, and I quickly just put out there why. You can get 80%, you can get 85%. 75%, arguably, at least in our mind, is the right balance between being ambitious, but also being safe. Now, what you really want to do is get a 75% loan to value mortgages, and then over time, let that drift down to about 60, 65%, 55% over the long term, and reduce the risk even more, particularly in terms of market corrections. Arguably, if you're 85%, you're more exposed to market corrections, house prices coming down, and then breaching your mortgage conditions. So for us, we go for 75% because it's the right balance. What's right for you, you'll have to decide. But for purpose of this example, we have then gone for a 75% loan to value interest only mortgage. And here we are, 75% loan. And like the previous cell up here, this one is editable, so we could say it's 3%. And if you go from August to August 2020 to 2021, it's about 3% in that 12-month period. We would like to probably go for 2% because that's the Bank of England base rate sort of target at the moment. Now, here's the thing: the power of the purchasing power of your money will decrease by the rate of inflation. So, after 1 year, that £75,000 loan has shrunk in real times in terms of the buying power of that money by £1,500. And as you can see, over a 10-year period, it's shrunk. The buying power of that money has shrunk by 13,720, meaning your loan in real terms in 10 years' time, and this introduces us to an idea of the time value of money, which I'm going to do the next video on, so stay tuned for that, is £61,280. And what I'm going to do now is I'm just going to add in that series of data and apply. And so you can see now that you start off with a 75% loan to value here, £75,000 of the £100,000 at 75% loan to value. Now, and if I just put this in black, you can see that. Over here, you will see that now you've got £61,280 of the increased value of £162,289, and forgive me not including my unit of measure. As a math teacher, that's atrocious, but you know, that's how it is. You can now see that proportionally, this space here, the loan amount to the value complete is much smaller. The loan is much smaller. It's 38%. Here, the loan is much larger, proportional or relative to the actual value. So the actual power of your debt has shrunk, not just by shrinking on itself, but being exacerbated by the increase of the value of the asset. And you can, of course, then refinance, and you could pull out 3/4 or 75% of this increase and you can go and keep buying another house. Alternatively, if you do capital repayment, you keep paying that debt off and it will decrease even more. But why would you do that? Because you see, inflation is going to be eroding the power of someone's money. So what our mind is, you might as well borrow it, fix it on interest only, and let inflation erode someone else's money rather than our own. And that's kind of like one of the key principles behind it. And you can really see that in terms of this graph. So I hope you found it interesting. It's certainly something you can perhaps factor into your own considerations when buying or refinancing property. But for us, interest only is incredibly powerful when you combine the eroding power of inflation and the growing power of capital appreciation. Welcome your thoughts. Are you in agreement? Do you disagree? Have you got any other insights? Feel free to share them with us. Let us know where you stand. As I say, the next one is going to look at the time value of money, so stay tuned for that. As always, thank you ever so much for your support. We do really appreciate it. My name is Josh Harrison, and I look forward to seeing you in the next one.